Good everyone, welcome back to our next edition of Econ Talks. Gareth, we've had the latest Infometrics quarterly forecasts come out, and they are showing a more optimistic view as we head forward. You're, of course, chief forecaster, so you know them far better than I do. What's the breakdown? What are we looking forward to in 2025?
Yeah, it's been a couple of years probably since we've been able to put out a forecast that's been reasonably optimistic. But looking forward, growth over the last 2 years has been essentially flat. We had a big recession through 2024, but now we're expecting economic growth this year to average about 0.5% per quarter. Now, that's not rip-roaring growth, but it does mean that by the end of this year, there'll be a bit of momentum building up in the economy. Year-end growth by the end of 2025 at 1%, but pushing up to a more creditable 2.5% by the middle of 2026. So there is, as I say, momentum coming through in the economy. That's reflected in terms of sort of household spending and household budgets as well. We know, of course, that mortgage rates have been coming down over the last few months. But for households, of course, it takes time for that to impact on their budgets. So it's only been since about October that the average mortgage rate being paid by households has been dropping. And so far, it's added about $8 million a week, we estimate, to household budgets in terms of what they can do with discretionary spending that previously they were having to pay through on the mortgage. That's not much, but by the end of this year, as people keep rolling off those higher fixed mortgage rates, it'll be up to $45 million a week added back into household budgets. That's effectively 1% of household spending. So you can see there's quite a stimulus to come through over coming months, and that helps to build through into our story of faster growth, particularly in the second half of this year as the economy regains momentum.
Okay, so we're seeing the greener shoots. We've seen the likes of spending activity start to push back up month on month through the end of 2024. We've started to see job ad numbers that are plateauing at quite low levels still, but again, not necessarily getting all that much worse. Job numbers maybe showing some early signs of turning around. Still expecting the unemployment rate to increase a little bit from here. It just always takes a bit longer for that full labour market impact to come through. But really what you're saying here is that there are those greener shoots that have shown through. We're expecting them to really sort of blossom as we move through more into mid and second half of 2025. It's not super immediate, but you're seeing some of that now. It comes through as that spending is unlocked. And like you say, $45 million extra a week coming through from households certainly starts to move things along a bit more. It takes a bit of time as everyone refixes, but okay, that's certainly more positive. At the same time, though, there seems to be a lot, or sometimes some expectations that interest rates are just going to continue to drop, and that $45 million a week just sort of continues to ramp up and up and up. We seem to be a little bit more conservative, highlighting a little bit more caution that actually we are expecting still that, people are refixing from their previously higher rates onto the sort of rates they can get now. But we're not quite so sure if there's still quite as much more to come. I mean, the risk at the moment does seem to be that the bottom of the interest rate cycle is a lot closer than expected. What's driving that caution?
Yeah, when we look at things over the last 6 to 8 weeks, the inflation sort of issues that have been coming through in the headlines and the stories have been very much about just upside risks to inflation. We've had international price pressures and persistence around inflation, particularly in the likes of the US. And of course, we've seen the Federal Reserve this week holding interest rates rather than continuing to cut. So that's just a sign that those pressures are a little more intense or a little stronger than might previously have been thought. We've got higher fuel prices. Their effect on overall inflation in the economy tends to be mixed, but certainly the Reserve Bank will be looking at those and going, well, there's risks again that prices of other goods and services will be pushed up as those fuel prices flow through into those other products. And then, of course, we've had the exchange rate down as much as 10, 11% from where it was a few months ago against the US dollar. And that adds to the price pressures around all imported products, as well as other stuff that's priced on the international market, such as meat and dairy products as well. Now, you put all of those together, we are looking for inflation to just pop back a little bit higher later this year. At the moment, we're forecasting to pick up to 2.3%, which is not much given that it's currently sitting at 2.2. But if anything, I'd say the risks are very much on the upside to that. I'm not saying it's going to go back to 7% like it was back in 2022. No risk of that. Still staying within the target band, I think. But overall, you look at those sort of signals coming through, and the Reserve Bank, okay, we're picking them to cut by 50 basis points at their next meeting in February, but the scope for further cuts beyond that does seem to be diminishing. At the moment, we've got a bottom for the OCR of 3.25%. Possibly the risks are that it's higher, And certainly when you look out to 2026, markets are just starting to sort of turn their thinking and go, well, maybe the Reserve Bank needs to start raising interest rates again. Now, those aren't built into our forecasts at this stage. We think 3.25 is an appropriate level to stick at for quite some time. But nevertheless, it just shows you how that sort of thinking and how the markets are just turning a little bit recently. And you look out to sort of growth forecasts, therefore, beyond mid-2026. And while we've got economic growth picking up to 2.5% at that point in time, we don't see it accelerating beyond that, because you will start to see economic conditions just not favouring a further acceleration in growth beyond that.
Which is important because we also heard from the Reserve Bank this week in a sort of broader speech about the economy and sort of where things go from here. Not detailed on monetary policy and what they're going to do with interest rates sort of in the next couple of months, but more sort of thinking in the broad. It was interesting to see the chief economist at the Reserve Bank, Paul Conway, highlight New Zealand's poor productivity performance again, but importantly linking that to potential economic growth and highlighting that because we don't have all that much productivity growth coming through, our potential capacity in the economy really is quite limited going forward. Now, that's important because the closer actual economic growth gets to potential growth, the more risk you have that inflation number starts to spark up again. And so for the Reserve Bank, they're looking at the fact that you do have more economic growth coming forward just naturally, like we've been talking about, but that your productive capacity of the economy hasn't shifted out as much, which again, I think all together implies or signals that risk that we're highlighting as well. We're not necessarily at all saying that inflation is going to skyrocket upwards. We're not suggesting that the official cash rate has got to sort of start to push much, much higher, but it's just this risk that we might be closer to the bottom. We might not have quite as much room to maneuver between trying to get growth going without increasing inflationary pressures. That's the balancing act that's got to come through. And I think there's probably a little bit less room to maneuver on that balance as we go forward. So a lot in that, certainly better economic conditions coming, which is encouraging. That'll be good news for households, be very good news for businesses thinking about the year as well. Still some difficulties in the short term, but also not an expectation of absolutely wild, unabandoned growth as we go forward. It's still limited. It's still a bit constrained. We'll assess how all of that goes, including our forecast performance and what the Reserve Bank does next, what it means for growth and where we head through 2025 on one of our future editions of Econ Talks.